Ladies and gentlemen, boys and girls, children over the age of 18, I'm Tez, and that's Travis, and we are your favorite LOs. And on this episode, we're going to talk about, we already did a Terminology Tuesday, I think, about it, right, Trav? But we're going to get into a deeper dive into PMI and MIP. So that's the private mortgage insurance and the mortgage insurance premium for conventional and FHA loans. We're going to take a deep dive and tell you a couple of things about them, so that way you get a better understanding of what they are and how you can take advantage of these two things down the line when it comes to a mortgage. So grab a pen and a piece of paper and your favorite beverage, and we'll be back in a second to break down and dig deep into PMI and MIP. See you in a few. All right, folks, welcome back. And as promised, like I said in the intro, we're going to be talking about two terms that are related to conventional and FHA mortgages, that being private mortgage insurance, as well as the mortgage insurance premium. I guess I'll go ahead and start it off and give y'all like a brief overview of the two, and then we'll get into some strategies about the two. So then that way you guys kind of can be better equipped on how you want to proceed when it comes to deciding which loan is best for you. Okay. So, Travis, if you don't mind, I'm going to go ahead and take it, steal it away from you. Ladies and gentlemen, so first we want to talk about conventional mortgages, right? So with conventional mortgages, they are the ones that get the PMI. So conventional mortgages gets the PMI, the private mortgage insurance, right? And basically, you're going to have private mortgage insurance anytime you don't put 20% down upon the initial purchase of the property. So if you put down 19.99% for your down payment, you're going to have the private mortgage insurance, right? The one things that you do want to understand when it comes to the PMI, as far as those coming off, now they can come off when you reach 80% of your loan amount towards the value of your home, only upon your request to your servicer, right? So once you know that the value of your property versus the loan amount that you have is 80%, you can reach out to your servicer and request that it comes off of your actual mortgage payment. Now, when it reaches 78%, now, so let's say you forget that it got to 80%, but when it gets to 78% of loan to value, then it automatically comes off with conventional mortgages. Okay. So always remember, if you don't put 20% down out the gate, you're going to have PMI with conventional mortgages. Once you get to 80%, you can request it off. And then at 78%, it automatically falls off. On the flip side, when it comes to FHA, they have what's called the mortgage insurance premium. So the MIP. They also have what's called an MIP, which is the upfront mortgage insurance premium that's in the purchase of the property, right? Now with FHA, the down payment determines how long you're going to have the actual mortgage insurance premium on your FHA loan. And that threshold is 10%. Upon your initial purchase, if you put less than 10% down on a 30-year mortgage, you're going to have MIP for the life of the loan. Okay. So for the whole 30 years, no matter if you get down to 80% or 78%, it's never going to fall off. It's always going to be on there if you put initially less than 10% down. Now, if you put more than 10% down or 10% down or more, then the mortgage insurance premium will be on the loan for 11 years on a 30-year mortgage. Okay. So that's kind of like the difference in regards to the PMI versus the MIP of the two loans. Travis, to let me know, did I break that down correctly? I just want to make sure I didn't miss anything, because I really want the folks to kind of get the idea of the PMI versus the MIP and, the two different factors that go into it when it comes to getting those removed.
No, I thought you did great. One thing that I would clarify is that when we speak of, like those loan to value percentages, keep in mind that the number that we're comparing is your remaining loan to the original purchase price of the property. Now, if this is on a refinance transaction, it's the amount of the loan currently in comparison to where your home appraised when you got the refinance. Okay, so anytime we need to make adjustments to that, like let's just say I purchased my home for $300,000, right? And now I believe it's worth $350,000, and that's where I'm coming up with my own loan to value. Um, be prepared for the servicer to not always just broadly accept that, but sometimes they can ask for an assessment of value, which is kind of like a lightweight appraisal of sorts. So keep in mind when we speak of the percentages, we're most often speaking of the percentages of what's left in your loan in comparison to the original purchase price of your home. But I thought you knocked that out of the park, Tez.
Okay, awesome, awesome. So I probably should have kept it on you because, well, actually, I kind of have to ask you the question, like, what are some of the strategies that you would suggest for our clients, especially when determining? Because the rate, excuse me, the factor for MIP has changed with FHA loans reached recently. I know credit score plays a factor in the PMI and the MIP. So kind of tell the folks like what are some of the strategies you've seen that work best for clients in different scenarios that might help them and guide them to make the best decision on which loan is actually better. Because we've seen that we used to have that past stigma that it was always conventional, but now you know FHA is starting to get a little shine. So, what are some of the strategies you would probably suggest to a client that's talking to you for the first time as far as which loan to pick and which one's best for them between the two?
Yeah, yeah. I mean, I think that as of late, I mean, this channel has been singing the praises of the new FHA loans. They've gotten much more competitive. They've always offered some savings on interest rate for most of our clients. Because let's just be real, like most people in the world today don't have a 780 plus credit score. Right. So there's definitely some things there as far as benefits that they can offer. Having that rate drop on the MIP is important because that's overall that means a lower payment for your client, right? As far as strategies go, I think with FHA, there's not necessarily a big time strategy that would come into play for someone who might be doing what we kind of call like backdooring the PMI, because as Tez alluded to, you're paying it for a set period of time on a 30-year mortgage, right? In like your best case scenarios, you're paying it for 11 years if you put down 10% or more. Worst case, you're putting down 10% or less. You're paying that for the life of the loan. So there really isn't a lot that we can do there as far as like tips and tricks to work yourself around that mortgage insurance. The only caveat that I would really give you on an FHA loan is that you know, it's very possible that given the rate market that we're in today, you're going to be refinancing down the road. You're going to be refinancing down the road, whether it's into another FHA loan where your LTV will be better, or if it's into a conventional loan where you're going to lower your interest rate and eliminate your mortgage insurance altogether. Okay, so as long as that overall payment looks good to you, I would always encourage you to move forward with a file. Like, let's not run away, over some things that can be addressed as you move on in your home ownership. Um, but man, like one of the things that I get a lot is, like a comparison of interest rate and mortgage insurance. Okay, so to the public consumer, many people wouldn't quite understand why on earth someone putting down 5% would be offered a lower interest rate than someone who's putting down, say, 30%. Okay. But with the lenders out there that we work with, that's something that you will see from time to time. You'll see higher interest rates for people putting down 20% rather than 3%. And I think that when we have those conversations with our clients, it usually revolves around number one, like a confusion, right? Where it's like, hey, I'm supposed to be a really good client, blah blah blah, and really, let's just be straight up with our family out here watching videos. I mean, it means they're going to make less money off of you in the long run. So in order to offset that, they're going to charge you a higher interest rate. So, the next conversation that we have is like, well, Travis, I hear you on the lower interest rate, but man, like I don't want to pay mortgage insurance. I've had clients that have closed with 3% down that have added their 20% down payment to their first mortgage payment and requested to have the mortgage insurance removed. So that's a way that you can kind of like, we call it like mortgage insurance hacking, right? It's something that Tez and I have had some pretty deep conversations on for clients that, like let's just say you're moving up and you don't necessarily want to take the risk of selling that primary residence before you have your new primary residence. Well, of course, once you sell your home, you're thinking to yourself, like, I'm going to have all of this money that I want to put towards this next home. I just don't want to take the risk of being homeless. I'm currently closing 2 files next week of clients who have homes for sale under contract who will then essentially hack that PMI off in their first or second payment. Another topic for another day will be like the full reamortization or recast. Those are also very popular, especially for our people with lower interest rates. But that's really one of the things that I think I want the public to understand is that just because you have more money down doesn't mean you should use it at that very moment in time. There might be better things that we can do with it. So those are some of the hacking strategies that I implore my clients to use. So I wanted to share them here with everybody else. Tez, does that make sense? Any questions on any of that from like a overview?
No, I mean, I think you did a bang bang job when it came to breaking that down, and because we're not going to talk about the math, ladies and gentlemen, but when you do that, the backdooring of the PMI that Travis had brought up, and you put the remainder of that 20% down, you shave off several years of actually your loan amount. So it's actually it's got like multiple benefits of allowing you to get that lower interest rate out the gate, but then also shaving years off your actual mortgage, that you don't even think about when you do that. So I mean, it's a very, very it's something that we've done, like Travis said, a bunch in the past for folks who aren't super adamant about putting that down. But once we show them the math, just makes sense. There's no way around it. So no, I think you did a wonderful job in that regard. So I'm trying to think where do I mean, because I don't necessarily know if there's anything else that we need to kind of touch basis on. I think the biggest thing is when you brought up for conventional loans, if you really think you're at that mark, pay attention to your market, ladies and gentlemen. That's the one thing I wanted to add to Travis. Pay attention to your market, pay attention to what's selling. Whoever your realtor was, for your purchase, ask them like, hey, how are the houses around me appreciating? If you're not on Zillow all day every day looking at the houses that are sold in your market, ask them like, hey, in my area, in my neighborhood, based on the comps that are, relatively comparable to my house, how have the prices been going? Right. So then you can kind of get a gauge to where it's, hey, you may be able to refinance all of that PMI within a year. Because right now we're just still seeing, like, as much as the inventory is low, people are still buying houses, ladies and gentlemen. So the prices are gonna go up. So that might actually be, something that you would just want to ask and, keep in touch with your realtor. So that way they can tell you and inform you. So that way you're ahead of the game and you're not waiting on, that benchmark to happen. So, but no, other than that, excellent, excellent. Anything you
Actually,
want to
just
add?
went through that process. Just went through that process myself. So, um, it I think the biggest mistake we make as loan officers is trying to oversimplify certain things. One of the most important pieces is understanding how your servicer handles those things, right? Especially when, like Ted says, if it's a combination of you paying down and the market that's creating that value there for you, be prepared for a recertification of value. um, you know Make sure that you're doing your research, because like you don't want to pay, even if it's just a couple $100, to have someone come out and snap some pictures and give you a value. You don't want to be wrong, and a lot of servicers, they kind of count on you being wrong. Like they're going to call your bluff in a sense, and they're going to say, Ortez, if you think your house is worth $350,000, put up $250 to our team to come out and value that property, right? Be prepared to have those conversations with your servicer, especially when we're talking about market movement creating value. Right now, if you just bought your home for $300,000 and your loan to value on your current loan is now 78%, it's going to fall off. There's really no gray area. If it's 80%, you send that letter. It's really no gray area. When you start talking about that added value, be prepared to discuss that with your servicer.
Oh no, that was wonderful, wonderful. But I think that'll wrap us up for today's episode, ladies and gentlemen. As always, if you found this information helpful, please, by all means, click the like button, click the subscribe button, as well as the bell notification, so you're always up to date whenever we drop new episodes. As well, leave some comments in the comment section. Let us know some of the things you would like us to talk about, and we'll definitely take it into consideration. But with all that said, I'm Tez, and that's Travis, and we are your favorite LOs. Until next time, folks, see ya.